resume the recording. All right, welcome everybody. So this is the Transformational Tuesday. I am going to start off by putting my contact if you want to book a Zoom call with me in the chat. I love connecting with people. I love helping you to understand. You'll see later on, my mission is to help people learn all about passive investing. So if someone with their camera on can just give me a thumbs up that you see my screen okay, because I can't see when I'm presenting. Awesome. Thank you so much. All right. So today we're going to talk about why most passive investors misread returns and what is it costing them. So a lot of times, you think, oh, I know what the returns are going to be. So my goal tonight is to talk all about some of the different main returns and why you would want to know what they are and why, even though IRR is my favorite, it's not the only return that you should use for your measurements. So again, as always, this is an educational series. I am not a financial planner. I am not an accountant. I am not a legal advisor. Our goal here is to provide information as best as we understand it. You always need to do your own due diligence before making any investment decisions. So a little bit about Massive Capital. We're a vertically integrated real estate company. We're a developer of Class A retail and town centers, and we're an owner operator of value add multifamily. We are very Texas heavy. We do have two small assets in Denver, two small assets in North Carolina, about 196 units just in south in Warner Robins, Georgia, which is south of Atlanta. But again, we're very heavily focused in the Dallas area. We do land development, building construction, and building operations. We are partnered with Realty One, and I know a few of you on the call were on a tour. We did a tour in Houston of some of the properties there. They have retail centers, you can see. They have about 300 million in assets under management. Massive Capital has multifamily. We're developing this one X-Space with a different group, and we have just under 1,400 units apartments, about 2.10 million. So we raise equity from LPs, which we're going to talk a little bit. What is an LP? Through Realty Run, we do triple net leasing, which is on the retail side, land development, steel frame construction, and then we do have our Massive Masters, which is a great mastermind if you're ever considering to be active. I know several of them are on the call with us tonight. It's a great program. So as always, I like to start out with this slide. You need to understand what you're doing with your cash, right? So if you have cash, it gives you no cash flow, no leverage, no real assets, no tax advantages. If you're investing in bonds, you will see a little bit on cash flow, a little bit on tax advantages. Stocks, you will get some cash flow, some leverage, but only real estate offers you cash flow, leverage, real assets, and tax advantages. And we're going to talk a little bit about those today. So again, we're going to talk about some of the syndication returns. I'm only talking about the big ones here. I'm not going to spend too much time on some waterfalls or some high level things. But first, we're going to talk about IRR. IRR is my personal favorite, and I'll explain a little bit why it is, but it's not the only answer. Then you'll see ARR, and you'll see these often on projections. You'll also see this thing called cash on cash, an equity multiple, why you must look at all of the estimates. And I want to make sure I'm clear here. Every time you see a syndication offering, they are estimates. And you need to do your own due diligence on those estimates. I have a personal belief that my mama, when she told me if something sounds too good to be true, it probably is. So if somebody's promising to triple your money in a year or 2 years, be cautious. Okay, you want to make sure that you understand them. And then what else should you consider before investing? And then we're going to talk about the power of syndications. So again, a little bit of syndications. They're real estate where a group of investors pool money to buy or develop real estate. Syndications are a way for investors to invest in larger properties that they couldn't afford on their own. Syndications are totally passive. So how it works, sponsors, general partners, they're experienced real estate professionals who organize the syndication, secure funding, again, normally bank debt, and they implement the business plan. Then they combine, they get investors that are limited partners, always referred to as LPs, and they help fund the project and they own a portion of the asset. So again, some of the benefits are limited liability. You only at risk for your investment. You have no other risk. You are protected. So if there's some major catastrophe, some sort of claim, you're protected. So I want to make sure clear again. If you put 50 or $100,000 in, you could lose all of your money, a portion of your money, or again, we could meet or exceed the expectations. They're targeted investments, so it allows you to invest in certain projects. So again, let me just finish this. They're tied directly to the success of the project, and we're going to show a couple of examples of what this means. There are several of the deals that Massive Capital does that we don't get paid anything until we've met certain goals. So a little bit about myself. I've been a passive investor in 20 syndications, and I'm on my 13th as an active investor. So again, I've invested heavily as an LP, and then I'm involved on 13 deals as a sponsor. So again, I've got lots of experience in this space. Again, does not mean I know everything. So making sure that we talk about the rules for syndication. There are two real types. There's lots of other ones, but these are the two main ones. A 506B, it means I can't advertise it, and I must have a pre-existing relationship, and you must be considered a sophisticated investor. So what does that mean? It means you understand the basic risk and reward. So at Massive Capital, we start all of our deals as a 506B because we want to give people an opportunity they're not accredited to be able to invest. But I want to make sure I'm clear. We must have a pre-existing relationship. So you must book a call with me. We must talk with you, and we'll go ahead and find out, do you understand the deals? What are we going on? What are your needs? What are your cash situation? And it's my responsibility as one of the sponsors to find that out. Then we switch our deals to a 506C. So I'm going to talk about two tonight. They are 506C, and there's no restrictions on soliciting. So for example, if I had a 506B, I couldn't talk about it tonight because I don't have a personal relationship with everybody. I know many of you, I've invited many of you to the call, seen you week after week, but we haven't had that existing relationship. So I can't risk this being in a public forum. Plus, we send out the replays, so I'm not allowed to do that. The biggest ability to market to everybody on a 506C, because I can do it, but only accredited investors can invest. And that means you have assets excluding your home of $1 million, or income of 200,000, or 300,000 is or sorry, 200,000 single, 300,000 married. So something that a lot of people don't understand, there is no difference between 506B or 506C other than who can invest and can I advertise it. So again, when we're offering these to the people, it's basically a deal that normally might only be a 506C. If you look, everything you're seeing just about is only for accredited investors. And we believe very strongly at Massive Capital that we want to create a community. We want to educate that community so they become an educated, sophisticated investor. And we want to be able to give them the opportunity to be able to invest. I also want to note that there are only 35 non-accredited investors allowed in any syndication. So again, it caps out at 35. And which again, what we do is when we talk with you, we put a little mark on your file that says you're ready for the next 506B. Ready doesn't mean you're going to invest. Ready means you've shown interest and you would like to see these offerings before they get switched. We normally operate a 506B for about 3 to 5 weeks. It really depends on how things are going. We predetermine it. All of the things and all of the indications are already uploaded into the PPM. We've already disclosed that this is going to happen. And then what we'll do is we'll say, hey, listen, this is the last chance. You'll have this long to be able to invest in it. And again, when we invite people to an email, when we send you an email to invite you to a webinar, we have a tag that says 506B. So out of our 14,000 people in our database, about 5 or 6,000 have that tag and the rest don't. So again, if you don't establish a relationship with us, you can't get the deal. Then we'll say to you, hey, listen, you've got 1 week left to get in the deal, how many every days it is. And then once it's closed, it's closed. There's no back door. Once it switches to 506C, we must follow the different regulations and only accept accredited investors. So you'll see a lot of funny pictures of myself. I like to make funny pictures. So understanding the returns. So again, my favorite return is the internal rate of return, and you'll often see that specified as IRR. So IRR stands for the internal rate of return. It's a critical metric for evaluating the profitability and overall return. It's a way to measure the annualized return, considering the time value of the money and all of the cash flows in the investment life. So I have some examples of how different deals and cash flow in a little bit coming. But IRR in simple terms is really the time use of your money. So the quicker you get your money back, normally the higher the IRR is. The slower you get your money back, the lower the IRR is, because it's the time use of your money. And then you'll see some examples later on. Some deals may have cash out refis. They dramatically increase the IRR because you're getting a big chunk of your cash back already. So again, it's the time use of your money. So again, it's a comprehensive metric that evaluates and annualizes the rate of return on investment while considering the time value of money. So it accounts for all cash flows, rental income, sale proceeds, holding period. So gets a little complicated here. So the discount rate that makes the net present value of all cash flows from investment equal to zero. In simpler terms, is the annual rate of return that you would expect on your investment, accounting for the timing of cash flows. You got to get an F there. And again, hopefully you're not more confused than you're starting. Some important considerations. IRR assumes that cash flows are reinvested at the same rate. So again, you have to make sure that you're knowing that. It may not always be realistic in it might not always be realistic in real estate, where cash flows can be invested in various ways. The market may not offer the same returns. It's also critical to understand and consider the equity multiple. The total return is the percentage of the initial investment alongside of the IRR will give you a complete picture of the investment's potential. So again, I hope that you're not really confused now. So what can make a huge difference on IRRs? The timing of cash flow. The earlier the cash flow results in a higher IRR, even with similar cash flow projections. Cash out refinance can significantly alter the cash flow pattern of a property, making it essential to recalculate the IRR using the new loan terms, cash out amounts, and any potential tax implication or the property increasing in value. The impact of the IRR can be positive or negatively, depending on the specific circumstances of how the cash out funds happen. So again, there's lots of considerations. It's a complicated formula, but it's a very powerful formula that you need to understand. So hopefully this next chart helps you to understand. So I tried to boil this down to make it, this was a chart I stole from somebody off the internet, but it's a great one. So this one is the best case scenario. Okay, so you made $100,000 investment. You got about 40,000 in year one. You got about 50,000 in year two. You got about 60,000 in year three. That's resulting in about a 21.6% IRR, internal rate of return, over the 3 years. This also assumes you've got your 100,000 back, okay? Higher earlier cash flows. So you put in the 100,000, but year one, the property was really singing, gave you 60 instead of 40. Still gave you 50 here, gave you a little bit. So remember, all of these numbers are adding up to the same total, but your IRR is 25.3%. So this is a higher IRR, which means if you got this $60,000 back, you need to keep that money always moving. But again, they've returned that to you earlier. So here's lower cash flows. So you put 100,000 in, you only got 20, then you got 50, then you got 80. It means it's an 18.1%. And then if you put in 100 and you got 150 at the end, but no cash flow, it's only a 14% IRR. So I hope this chart helps you to understand a little bit that it's a very much a moving target. And you have to remember when a sponsor's giving you a deal, they're estimating the returns, and those estimations are what are affecting the IRR. So again, early cash flow is great for IRR. So let's talk a little bit about annual recurring or ARR. In syndications, ARR stands for annual recurring revenue. It refers to the total revenue company expects to generate from recurring subscriptions contracts in a 12-month period. It's an important metric in syndications because it provides lenders and investors with a reliable measure of a company's predictable income stream, which is often used as collateral or financing. So ARR is calculated by dividing the average annual return profit by the initial investment. So again, I hope I haven't got you totally confused. But so the main difference between ARR and IRR lies in how they're calculated and interpret the returns on investment. So again, I know this gets very complicated, but ARR is a simpler calculation based on an average annual profit. So it annualizes the profit divided by the initial investment, while IRR is more complex calculation that considers the time value of money. Well, I got to fix a lot. I got a couple of typos here. So again, doesn't mean ARR is better or worse than. It's just a different way for you to understand your money. I particularly really like IRR because I want to keep my money moving. So it determines the discount rate, the present net value of all cash flows equal to zero, and it provides a more comprehensive view of the profitability. So again, here's some key differences. The calculation, it's an average annual profit and takes into account the initial investment, where IRR considers the time value of money. This one ignores the time value of money. IRR considers the time value of your money. ARR is quick and simple to measure it, but IRR is comprehensive view of the profitability. So for example, $1,000 profit on a $10,000 investment, the discount rates for which a 10,000 investment is returned. So again, simple and more complex. Hopefully, I'm not making this too complex. I'm trying to boil it down. So I'd have some other things here we're going to talk about, and then I'm going to look at a few deals. So cash on cash. Cash on cash is in the context, cash on cash measures the annual pre-tax cash flow generated by a property, and it is expressed as a percentage of total cash invested by the syndicator investors. Cash on cash return provides a quick assessment of how efficiently the cash invested to a property generates income. It's a key metric for understanding the immediate profitability of an investment, focusing on the cash flow produced by the property rather than the actual appreciation or debt payments. Okay, so again, we have another here. Sorry, let me just go through this one here. Cash on cash. So cash on cash, and I'm going to show you some examples of where cash on cash is calculated. But sometimes when it's calculated into a return, you may not see it. So we're going to get into that again. So this one here is a really big one here. An equity multiple is also stated as a number like 2.1. So in a real estate syndication, an equity multiple is a financial metric that measures the total return of investment relative to the initial equity invested. So it's calculated by dividing the total cash distributions received, including cash flow, proceeds from a sale, or initial equity investment. All right, so equity multiple is a very important term. But what I want to do is I want to talk a little bit about some other one here. Oh, let me just finish equity multiple. So for example, if an equity multiple is 2, it means that an investor has doubled their initial investment. If an equity multiple is 1.5, it means that you've received 1.5 times your initial investment. A little bit later on, though, we're going to add time into these calculations, okay? So if I double your money in 5 years, which is a typical normal goal of a syndication, that's one thing. But we have some shorter term deals that are 3 years. where we're 1.56, 1.7 multiple of your money. So you have to look at all of the different considerations, but it shows how much an initial investors is multiplied over a period of investment. So again, this is a super powerful tool because especially if you're starting out, the most important thing with real estate investing is obviously long-term wealth creation, right? So you want to double your money. So the goal is double your money every 5 years. So again, what's the best measurement? In summary, equity multiple and IRR offer different perspectives on investment return. Equity multiple provides a simple view of the total, while the IRR does a time-weighted view of the profitability. Savvy investors utilize both metrics alongside other due diligence to make informed decisions. So again, a little bit more data. Equity multiple, all the cash returned during the holding period. Equity multiple is simpler to the total cash on cash return. IRR, I'm talking way too fast here. We're getting through these slides real quick. So we better have lots of good questions at the end. IRR reports the percentage rate earned over each investment period. Equity multiple is the ratio between the total cash received and the equity invested over the period. IRR can be manipulated by the cash timing of the cash flow. Can this be good or bad? So if we go back to this other slide here, let's just look at this other slide here. Is number one better than number two? I think it is. Why do I think it is? Okay, so even though I've got 90, I got my money back here and I got the same amount of money back here, I got my money back quicker here. So again, I want the highest IRR because I want to get my money back quicker. Gladly take a hamburger today than maybe two tomorrow. Wimpy says that. Again, I want to make sure the quicker I get my money back, I want to deploy it. So when I get this money back here, I want to redeploy it into another investment so that it can keep working, right? So again, it is the time use of your money that becomes super important when you start looking at different metrics. So let me just get down here back to where I was, sorry. Oh, I sure talk fast, I got a lot of slides here. Okay, so other things that you must talk about. So if I double your money in 5 years, that's roughly a 17% IRR. If I 1.6 your money in 3 years, that's a 20% IRR. So again, I'm going to show you two deals. One's a 5-year deal, one's a 3-year deal, so that you can see that the higher IRR is higher here because again, I've 1/6 your money, and it's more complicated because the math isn't necessarily lined up, right? Double and 5 years and 3 years. It'd be easier if this one was 2.5 years, but again, a lot of the deals aren't. But there's so many things that you need to also add into your calculations. So one thing is huge is you want to know, do deals have tax and bonus depreciation? So for example, we have several deals that you're going to get bonus depreciation on. By the way, I want everybody who's paying attention to cross your fingers that they pass the big beautiful bill and bonus depreciation goes back up to 100% from 40. That is going to be life-changing for real estate investors. And we'll talk a little bit about that in a moment, but it is huge if you can use the bonus depreciation. Actually, let's talk about it right now. So for example, on some of our deals, we have one right now. If you invest about $100,000, you're going to get about a $26,000 passive loss. Well, if that was back up to the 100%, it would be closer to $60,000 passive loss. So again, as a real estate professional, you can use 100% of that money against your total taxable income. As a passive investor with a W-2, you can use that money against your passive real estate income. But the beauty of it is, it's not a use it or lose it. So it's a super powerful tool. So again, when I first switched to being an active investor, I did have a job.
And now, here's someone you want to hear from, our sponsor. For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
Let go for my job. I was paid severance. My severance was taxed, but at the end of the year, because I became a full-time real estate investor, I didn't have to, I got all that money back. Had to pay in on my severance, which I again could turn around and invest. So again, you need to understand that when is cash or cash may not be better. So for example, if you have a retirement account, small amounts of cash coming into your retirement account can almost be a little bit of a nuisance because you can't reinvest them. So I made some mistakes early on. I've got a couple investments that pay pretty regular into my retirement account. But until it reaches at least $25,000, it's just stuck there doing nothing. It doesn't earn any interest, can't move anywhere. Nobody wants me to loan them $6,700, right? Everybody's looking for 25, 50, 75, $100,000 investments. So sometimes when you look at an opportunity to invest, you want to make sure that you know, okay, what is going to happen? How can I keep this money moving? Because again, moving money is where the real money is. Do you plan to live off the investments or create generational wealth? Huge difference on how it's going to affect your total returns. And I'm going to talk about that more at a different slide. If you get a cash out refinance, do you have a place to keep that money earning? So again, a cash out refinance. So let's say I put $100,000 in a deal. They did a cash out refi, which is pretty challenging right now with high interest rates. But let's keep our fingers crossed again that it gets to that point where refi works pretty good for it. And so what happens is we're going to be able to get that money back. So if I invest $100,000 and then they do a cash out refi and they manage to give me $40,000 back, that's great news, right? Because I can turn around and add a few $1,000s to that and make another investment and keep my money moving. It will really dramatically increase my IRR, and it dramatically increases my total wealth production because they gave me some of that money back and I managed to reinvest it. So again, super, super powerful. So I got a couple of deals here that we're going to look at. So this one was one, and it says B up here, but I grabbed the wrong slide. It was like, this one's closed anyways. So this was a particular deal here. This is a new development deal, new build retail. So we're doing a 21% internal rate of return. That was the 1.6 over 3 years. We also have this thing which is called the 7% preferred, and I'll get that into a minute. Again, this one is a little more complicated because if we do less than a 17% IRR, the split is 70-30, which means the investors get 70 and me as a sponsor get 30. But if we achieve what our goal here is, 21%, it actually goes to a 50-50 split. So let's go through that first. So again, you put in your $75,000, and we've shown it here as 100. So until you get at least 7%, so that would be 7,000 this year, 14,000, 21. So as long as you get $21,000, we start the split. Then once we get the split going, we're going to take a look at the total deal. And if we can give you more than 17% from this particular deal, the split goes up to a 50-50. So I want to explain how you're going to look at this deal. Okay, I'm going to put $100,000 in until I make at least 21,000 on my deal. The sponsor's going to make no money. Then if they don't do anything above 17% IRR, they're going to give me a bigger split. So 70 cents on every dollar earned is going to go to the investors, and 30 cents of every dollar earned goes to me as a sponsor and my team. But if I achieve my goal, it turns into a 50-50 split. So again, you have to remember, you get paid first, you get paid more if I'm not successful, and we both get paid more if I am successful. So again, that's the way to look at this, right? When you're analyzing a deal. Now, again, remember, these are all estimates, different things that can happen. This one also, because it was a retail development, there is no depreciation with it. So this is, you put 100 grand in, we sell the property, we give you 160,000 and a bit back, and that's your 1.6 multiple. There is no cash flow, there's no anything happening, there's no money paid because again, we don't have any money to pay, right? We're building this, we're leasing it up, and we're going to sell it. So let's go on to, these are two deals that I currently have, and I'm just going to read the cash flow option two. Can you, let me just read this to make sure I answered her question correctly. Cash flow was a good option two. Can you do a cash out refi if you owe a prop Oh, on a property, what about a condo? So again, I'm talking about syndications, not individual unit deals. So I'm talking about when we do a syndication deal. Again, you can do cash out refis on anything. A little challenging right now because interest rates are higher probably than your loan, but you can do a cash out refi. But again, it's, I don't know anything about a single individual unit. So this is where we would say, okay, we've increased the value of the property. So again, this particular property here, Horizon right now, let's just talk about it. If I can increase rents by $100 a unit, that's for 200 units, that creates $4 million in value creation. So we bought it at just under 17 million. So if I can, within the first 2 years, create $4 million worth of value, that property is now worth $21 million. Could I refinance it? Again, not a very good option right now because we're at a 4.45 blended rate. It's going to be a higher rate. But if I could do that, I would be able to take some of it. It's like the BRRRR strategy. I would be able to take some of the money I earned back out of the property. So again, that's a different way to look at it to make sure that we understand. So this one is for the horizon. So again, this is a little bit more complicated here. So this one is, again, this assumes you invested $100,000. It is an 18% IRR. It has about a 7 to 8% cash flow. It's got about a 2.1 multiple. It's got a 22 to 23% annualized return. So again, you can see these numbers are different because they measure different things. We're doing a 70-30 split. This is the cap rate we purchased at. Sell. We've raised, actually this one here now, we've raised over 7 million with a 5-year hold. So I want to explain how this deal works. So in year one, we've said we're only going to produce about a 5% cash on cash return. Remember, we owe you 7. So again, you're going to get some money, and I want to make sure I tell you on the timing of some money. You'll probably get a lot of this money in year two, even though you might earn it in year one, because normally we take about 9 months to stabilize the asset. Then we make a fourth quarter payment, which really comes in first quarter. I know it sounds a lot of complicated, but it's this tax year. So then in year two, we're doing a little better. So you're going to get 7.53%. Again, we still haven't caught up to your 7% preferred return. So remember, it keeps accruing. So until we get into year three, pardon me, you've seen here, we're just over almost 8.5%. We've pretty much caught up now on your 7% preferred over 3 periods of time, 3 years. So you've gotten back now about $21,000 in cash flow. So we start saying, okay, now we've made some money. We're going to start doing this 70-30 split. Then year four, it's a little better. Year five, it's a little better. And so during this period of time, you've received just over $39,000 in cash flow. And then you've received about $71,000 from the profit. So you gave us 100. We give you back 210, which is a 2.1 multiple. So again, I want to make sure you understand when you're looking at these deals, I wanted to show this. So if you're just saying, well, I'm only going to consider IRR, that's okay. But you got to look at everything kind of as a total when you're doing it. You also have to look at, do I need this cash flow to live on? Or am I going to keep the cash flow moving? So myself, I'm an investor for long-term wealth creation. So long-term wealth creation is all to do with growing my money as quick as I can, right? So my goal is not to live on my returns. My goal is to have my money continue to work. And we'll talk a little bit about that in another slide. Here's an interesting deal. This is the Vale Apartments here. And by the way, I have two spots left in each of these deals if anybody's looking to make a passive investment. They're both for accredited investors only. This particular deal is a little bit unique that how they're structuring this deal is they're taking $100,000 investments again, and they believe their cash flow will pay this preferred return, but any additional cash flow they're keeping for the project to make sure that they have building up on their reserves. So I'll show you a slide here in a minute on this. So they're saying, okay, we're going to pay you 7 this year, 7 this year, 7 this year, 7 this year, 7 this year. So you're going to make about $35,000 through the 5-year hold. You're going to get about $95,000 from the sale. We're going to give you your $100,000 back. So that comes out to a $230,000. So that is a 2.3 multiple of your money. Sorry, it was right there, blind here. This run, remember, you're going to get a bonus depreciation in the first year, and still that's at the 40%. So you're going to get about 19,000. You'll still get some over the other years. So again, this one has the 7% preferred return. This is their annualized return. Their IRR is actually about 21%. And the reason the IRR is a little bit lower because they're not going to be paying you any more than $7,000 on your 100. No matter how well the property does, their business plan is to hold that cash. And so again, you're going to get all of these things. I'm going to quickly stop share and then quickly just pop over to one more thing because I really want to show you how this, because this is super important for you to be able to see this. Let me just, so we're going to go back to sharing. I know this is, so this is the full underwriting for this particular property, okay? Um, but it's very interesting because nobody ever shows you what I'm going to show you necessarily today. So just to give you an idea how you look at underwriting, and again, this is something, so this is the actual T12 of the current property. So they have all the information of the current property. And just to let you know, chances are it's a T3 annualized because you'd always kind of, how are they doing right now? And then you annualize those numbers. So again, this is all the important numbers, right? So that, and this one here, gross potential income, that's how much they would make if they were 100% full. Okay. And then you have things like vacancy. So we have vacancy and we have total loss or concession. So those are where somebody skips, doesn't pay you. It takes you a while to lease it. I say, hey, if you move in here, I'm going to give you 2 weeks free. I'm going to do this. I'm going to do that. So all of those numbers are in there. And then again, all of these tax numbers are all of the operational numbers. And if anybody wants to see this, just send me a note. I'm happy to share or to do a call with you. But this is where I wanted to describe the very bottom piece here. So they actually have a preferred member class, which is full of 17%. This 17% comes with no upside. And I want to make sure you understand too, these are things you have to learn. Bank is paid first. 17% guys are paid second. 7%, which is the passive investors, are paid third. And until the passive investors receive at least 7%, sponsors receive zero, and then they're fourth to get paid. So if you can look here, so these are numbers that you don't often see. You'll normally just see up to net operating income. Okay, and so they have some capex reserves that's lender required. You have to stick money aside and not do it. This is the interest payment. So this particular property has an interest only loan for the first 3 years. So if you look interest only is interest in principal, interest in principal. You can see it goes up about $50,000 once they start paying off principal. So this is available cash flow. This is available for the asset management charge. This is where the preferred folks are getting paid. So you can see here, they're a smaller group of people, but they get paid first. Then the second group of people get paid. So I want to show you year one's pretty skinny. We got 1,500 bucks left. That you got to be pretty perfect to make sure. So the chances are there might be a bit of a rollover on year one just because they've been ramping up. But right now they're showing that they can make the full 7% payment. Now on year two, same thing happens again here. These guys are getting paid. Second people are getting paid their 7%, but there's $50,000 left in cash flow after that. There's $84,000 in cash flow left after that. There's 41,000 because they're now paying off the mortgage, and then there's 56,000. So again, there's lots of different things to look at here, but what I want you to understand is this is all the different things that will go into a calculation. So again, asset management fee is here, all of the different things. So this is how that you're going to build it, right? And this is how they'll build the back end of it, and then they'll make the various predictions from this. Okay, so hopefully that helped a lot. That was, let me go back to my other slide here. We got a great crowd tonight, by the way. I really appreciate everyone showing up. So here, again, goes back to this particular opportunity. So again, this one, I do have a couple of spots if you're an accredited investor and looking to invest. This, by the way, is a nice solid B class property. So this is how they've calculated it. So my favorite statement that I make every year or every class, every time I have, if you don't find a way to make money while you sleep, you will work until you die. So again, remember on syndications, you are giving your money over to us as the sponsor. We're creating a syndication. We're creating a business plan. We're creating a way for you to have your money. We're paying you first. So we're doing a 7% preferred. Sometimes there's a waterfall on the split, but we don't get paid until you get paid first, and then we split it. So again, on a normal split, we're talking about 70 cents of every dollar we make goes to the passive investors, and 30% goes to us as the sponsors. So again, it's a really good way for to be able to get your money, to keep your money growing. So this is my favorite slide. So remember I talked about keeping your money moving. This slide talks about keeping your money moving and the compounding of your money. So the earlier you start, so if you're earlier and younger than I am, I wish I'd have started this a long time ago. So that's why I always talk about don't wait to buy real estate and wait. So let's assume you double your money every 5 years and you have no tax issues. So again, I'm just using the simple multiplier of you double your money every 5 years. So if you get any of these other instances where you get money earlier, you have to keep your money working. And again, this assumes you have no tax consequences. Again, that's a big assumption. So both of these are big assumptions, but I don't know your tax bracket. I don't know where. I know real estate will provide you the most tax efficient way to invest. So again, you invest 100, let it go for 5 years. It makes two. Then you take that two and you let it go for 5 years, it makes four. You take that four, you let it go for 5 years, it turns to eight. You take that eight, you let it roll for 5 years, becomes 1.6 million. You take that 1.6 million, you let it roll for 5 years, becomes 3.2 million. So even if I've grossly overestimated your returns, we are talking about you made one $100,000 investment and you kept reinvesting. I want to make sure that you understand the power of this. This isn't that you had to keep investing. This means you invested, you always doubled your money, you didn't have a tax complication because you were very thrifty on how you did it. Again, it's not how much you earn, it's how much you keep. But think about this. This is, remember I talked about how time use of money, why I like IRR, because I want to keep my money moving, right? So this assumes that you started with $100,000 and you just kept reinvesting. Now, again, I'm not saying you're going to put 200 in one deal. This may be 4 deals, and the timing, and this is perfect timing, right? Sometimes it may take you 3 months to find a deal you like. Sometimes it may take you, even longer to find a deal you like. I'll give you an example. I invested in a deal in Tucson, Arizona. It was wonderful. They were supposed to give me a 17% IRR. They gave me a 53% IRR. They tripled my money in 20 months. I gave them $50,000. 20 months later, they gave me 152 back, and they had a deal that was just about to close, and literally the money showed up in my bank account, didn't even have time to get cold. I invested. So trying to keep my money moving all the time, right? Super, super important to be able to keep your money moving. So again, we talk about actively passive. So if you are looking to be actively passive, you're going to want to come to these meetings. You're going to want to learn about different things to do with investing, understand to be able to invest. If you're interested in actively active, in other words, you would say, well, listen, I'd really like to do what Trevor's doing, or I'd like to do with what some of the other folks on this call are doing. If you want to join another call at 7 o'clock, my main mentor and several of my friends on this call's main mentor, Phil Grove, is doing a presentation about massive masters. And this is our Centurion Expo, but they'll talk to you a little bit about how you can make money as an active deal sponsor. That's out there, and there's a QR code for it right there. But I put the link in the chat. I'll keep this up for a second. I should have moved it a little bit quicker. So you want to make sure that you balance your investment portfolio. So you want to consider risk. Man, I got to fix that reward, the time, and the asset class. So again, you're going to move your investments through different things. I've used this analogy several times. If you are in the Dallas area, I'm going to be there on June the 19th. Check out this. We're going to do a property tour of one of our properties in Fort Worth, and we're just going to walk you through the property, tell you how we do with our multifamily. If you are a lady on the call and you have not joined our She webinars, you are missing out. So this is my counterpart, Jasmine. I am officially the president of the She fan club. I send tons of ladies to the She events. They are amazing events. In a minute, I'll show you my screen where I'm wearing a wig at one of their events. And again, my goal is to help people, 100,000 people, reach financial independence through real estate investing. And I hope you're one. So I am going to stop sharing. I'm going to also re-put in my full contact info here. So on this particular contact, the first one is my link tree, which you can connect with me on LinkedIn or my Facebook group. And the second one is if you just want to go ahead and book a Zoom call direct. I am going to check the chat to make sure. Yeah, it's hard to zoom into a spreadsheet. All right, did I get all the questions? I think I got all your questions. And you can unmute now if you want. You can pop them in the chat. I really coming to Dallas. It's going to be on June the 19th. We're doing a property tour. I'll put it in the chat here. We're doing a property tour. Let me just find it here. Too many tabs open. Yes, this will be on YouTube within 48 hours. And you can go over to the Massive Capital. I can find that one easy. I'll put our YouTube channel in there. And they usually by Saturday, they also send an email out with the replay. And let me just try to find my property tour. Sorry, in Dallas. Any other questions while I'm humming away and looking? Did I do such a good job that you don't have any questions? Now I can't find it. Just connect with me on one of my socials and send me a link. It'll be also posted on my Facebook page. I thought I had it here. I'm usually pretty good at making sure I got all my links, but I don't see it. Sorry. Let me go back here. Yeah, actively passive. It's you got to be educated. It's very confusing. I remember when I first invested in a deal, I didn't have a clue what I was doing. I'm going to be honest with you. I just, I met some people that I knew, like, and trust. I spent some time. And then as I got more and more and more involved into it, I started being able to ask different questions and different things. But it was really, you just gotta ask questions. And again, let me make sure that I'm clear. If it sounds too good to be true, it probably is. Okay. I get tons of emails. Yeah, the rule of 72 is so powerful, and that's really to double your money in 5 years. When you get paid on the deal, if you're a GP, so everybody gets a K1 no matter who you are. And the K1 is a taxway. So if you're a passive investor, you'll get a K1. If you're part of the sponsorship team, you'll get a K1. So that's how that you get your what you earn as on the different deals. So however you are, and again, so active and passive investor depends on what percentage you own in a deal. So again, you'll see that when you fill it out, you own this much percent of a deal. And then myself as an active investor when I'm on the investor side. So you got to remember, we have a fair bit of mouths to feed at Massive Capital and different things. So we get a percentage of the deals. And investors are normally paid quarterly. And sponsors, I'm going to be honest, you really make your money at the end of a deal. And again, while that doesn't help people wanting to be active right away, it aligns people's interest rate. I don't get paid till after everybody else gets paid. Therefore, I want to do the best job possible. But on passive investors, they're normally paid quarterly. But if you remember on some of my examples, some of the value add multifamily, takes a little while to ramp up the cash flow to be able to pay you. And on the new development deals, there is no cash flow. So you put 100,000 in, we sell it, you get your money back at the end. And again, when we talked about being a smart and educated investor, I highly recommend if you have retirement funds and cash, you consider how you're. So I did this once and I did it wrong. I put a retirement fund on a multifamily and I put my cash on a development deal where I should have done it the other way around because the multifamily with cash would have given me the tax benefits, the depreciation. Nobody educated. So again, my goal here is to tell you everything I did wrong so that you don't do wrong. And I want to go over one other thing with you here, just to make sure that people get the power of being able to use some different ways to earn money. Hold on, I'm going to end with this one because we talked about it. So if you remember this slide here, right, this is a very powerful slide. Okay, this is growing your money from this to this. So you got to remember, this is still taxable money, right? At some point, it's taxable money. But if you're young and smart, which I wasn't, and I was going to invest $100,000 and I decided I could afford to do it, and I prepaid the tax and I put this into a Roth IRA, that $100,000 that grows to $3.2 million would be $3.1 million tax free. Because if you investing with a Roth IRA, it grows tax free. So picture this in your mind. Invest $100,000 from a 401k from a Roth where you've already paid the tax and you grow it, you're going to earn $3.2 million tax free. One other thing I usually do a lesson I didn't talk about. A lot of people say, well, I want to invest because I'm going to live off the cash flow. So if you invest 100, earn 100 and live off 100, you invest 100, live off 100, invest 100. In 25 years, you only have 200 left because you've continued to live off it, which is why, again, when I say you want to look at what are my goals, right? My goals always were that I have this much money to invest. I want to keep that money moving. I don't want to have to pull it out. And then for myself as an active, that's where I make my money that I live off of. So again, you really need to understand the power of using your money and all of the different things. Because again, at the end of the day, it's not how much you make, it's how much you keep. And money's not the ultimate goal. Freedom is, right? So the goal is that if you could produce $3.2 million in wealth for yourself, Or could you imagine but getting that money and putting it into one of your children? So instead of trying, I'm gonna just it would amazing how it could grow for you. So any other questions? I really appreciate everybody showing up tonight. It was great tonight. Remember, we do this every Tuesday. Oh, I promised I'd share my thing here. So just hold on a minute. Uh, so just to show you what a fan I am of the she, that's me in a wig showing up at one of their events. They always tease me because obviously I'm follically challenged. That if I showed up at one of their events, I had to wear a wig. And so, of course, I had to do that. It was a lot of fun. Awesome. Well, I appreciate everybody that showed up tonight. It was great to see you all. If you enjoyed yourself, if you learned something, please tell a friend. Please invite somebody. Our goal here is to try to offer you the information so that you can make educated. Yes, it'll be on the YouTube channel, and you'll get an email on Friday if you registered. I'll re-pop in the YouTube channel right here again. Um, that's my YouTube channel. Check out my YouTube channel too. I try to put a lot of good information in it as well. Well, I'm glad your daughter invited you. Did you enjoy it when you went? Well, thank you very much. Very kind of you. Excellent. All right. Enjoy the rest of your evening. Thank you very much. And we will see you in 2 weeks. Perfect. I don't know that person's name, Cheryl. Sorry. Okay. Awesome. Book a call with me if you want to connect. I love talking with people. Thank you.